Zscaler stock has plummeted from their pandemic highs. Just look at that. Nearly $400 per share at their high to $168 per share today. That is an enormous decline. Is this decline warranted? That's what we're going to discuss today. We're going to discuss their business, their finances, and my DCF valuation on Zscaler. We're going to know, is Zscaler worth $100 or is it worth $1,000? I'll show you my exact price target on this stock. So yeah, that's what we're discussing, Zscaler. And by the way, Shemao, can you see her there? She's a little sneaky. She says to like and subscribe. So anyway, yeah, Zscaler currently trades at, as mentioned, and it has a forward PE of 58.14, which seems high. Is it? Let's find out. So anyway, they have a price per sales of 11.52 that will play a factor later in this video, and a market cap of $25 billion. Okay, so what is Zscaler? And why does Zscaler even exist? And what's their business proposition? So basically what's happening is this, is when companies move to the cloud, there's basically 3 tiers of security. And okay, so tier number 1 is, I call it endpoint protection. And these are companies kind of like CloudStrike. Okay, fine. You don't want to be CloudStrike? Then don't release to production on a Friday. Then I won't call you CloudStrike. Okay? Oh, so yeah, you have endpoint protection. Then you have, identity services. This is basically identifying, who you are, who am I, essentially, and what roles and accesses you have. These are like, for example, Microsoft Active Directory and the like. Okta is another one that's very popular, actually, especially in Silicon Valley. And then you have 0 points application access, zero trust application access. And that's what Zscaler is in. And this is basically Zscaler is the leader in this category. And the thing is, these three tiers are complementary to each other. So for example, any company is going to want one product, or any cloud-based company is going to want one product in each of these tiers. They're going to want one endpoint product, one identity product, and one zero trust application framework. So they're complementary. So for example, you can choose, CloudStrike, you can choose Microsoft Active Directory, and you can choose Zscaler, and all three can work complementary to each other to protect your organization, and to protect your applications, protect your data, and protect your users. So what Zscaler does specifically is they act as a exchange, as basically a proxy between users. As you can see on the bottom here, users anywhere. So it could be your PC, it could be your phone, it could be any device essentially. And what it does is it goes through this proxy, which is Zscaler, is this proxy, the security proxy between the user and your applications. That's at a high level what Zscaler does. And they have actually different products for external and internal applications. Obviously, internal is moving to the cloud. Externals are things like, Jira, your employee, benefits, checking your payrolls and things like that. And it's making sure that you have secure access to these, and also that these sites themselves are secure from intrusion, from people coming in to try to access them. So what they do actually is your internal website, for example, it no longer has general internet access. All access is provided through Zscaler, which filters through and secures your system. Now, what Zscaler is also currently doing to improve their systems is they're leveraging artificial intelligence in order to more accurately crack down on cybersecurity threats. And they're doing 500 billion transactions per day. And what they define transaction as is some user connecting through their system to do something. So 500 billion per day. And just 4 years ago, they're at 30 billion. So they're expanding quite significantly. Now, one thing that's huge right now and people are focusing on is cybersecurity. It seems like every day somebody somewhere is being hacked. There's data being stolen, there's money being stolen, there's ransomware, all sorts of security threats. and new threats created every single day. Actually, Zscaler says themselves that they're preventing 375 million attacks each day. So people are willing to spend a lot of money to protect their systems, to protect their infrastructure, their data, their customers. There's a huge market for this. How big of a market? Some people think that there's a $2 trillion TAM here. I don't know if it's going to be that high, but it's going to be huge. The TAM here is huge. Let me move the slide a little bit. I'm getting blinded. Okay, so yeah, let's go into the last quarter's numbers. So yeah, they are the leader in cloud security is what they call it. $2.5 billion in annual recurring revenue. Now the CEO, Jay, thinks that they're going to be able to hit $5 billion in the medium term. So they think they're going to double their business over the next number of years. They didn't specify the exact time period. Now, they're above the Rule of 40, which is essentially, the Rule of 40 is a valuation metric for tech companies. And it's very simple. You take their revenue growth, in this case, it's 34%. And then you take their margin. In this case, they're using the free cash flow margin, although sometimes they use different metrics for margin. You add them together, and then if you're above 40, you're considered to be a well-run organization. If you're below 40, you're considered to be not a well-run organization. That's basically how it works. And analysts use this quite a bit now to analyze these types of firms. And yeah, as you can see, Zscaler crosses 60. So it's pretty good there. Pretty good. And then high scalable cloud economics, 81% gross margin, which is actually kind of expected in this field, but it's good nonetheless. And 115% dollar retention. So that means that their existing customers, not only are they not losing customers, but their existing customers are buying more. That's what that means. There's actually 15%. Their existing customers are buying 15% more than they did the previous year. So they're growing with their existing customer base and they're acquiring new customers as they go along. They actually currently control 35% of the global 4,000 companies. So yeah, on their fiscal 24 results, 30% revenue growth, 27% billings growth, 26% RPO growth. Customers with $1 million plus annual recurring revenues up 26%. Customers with 100, there's 567 of them. They have 3,100 customers with $100,000 or more recurring revenue, and about 35% of the global 2,000. Oops, which is and greater than 40% of the Fortune 500. Now, the one thing is the one I would say negative for Zscaler is they're already in so many organizations that this is what I think is making growth a little bit more difficult for them, and why growth is actually slowing versus their prior years. And this is what Jay also says: growth isn't going to be what it used to be. They're no longer going to grow 60%, 80%, 90% per year. Those days are gone. But that does not mean this is a bad stock. You got to go into the valuation models for that. So yeah, the fourth quarter highlights, as we already mentioned most of these. They also noted a GAAP net loss of $14.9 million compared to a GAAP net loss of $30.7 million on a year-over-year basis. Non-GAAP net income of $140 million compared to a non-GAAP net income of $100.9 million year over year. Okay, so what's the difference between GAAP and non-GAAP? Stock-based compensation. That's also the one negative for Zscaler right now is SBC makes up 25% of their revenues. So keep that in mind. And also I include stock-based compensation in my DCF valuations. I'll show you that in just a moment. So yeah, other highlights are GAAP for the fourth quarter fiscal 24. So yeah, the fiscal 24 just ended about a week ago. So yeah, the income per share was negative 10 cents, or the GAAP net loss per share 10 cents compared to 21 cents. However, the cash flows was $203 million, or 34% of revenue, compared to $135 million in the prior year. And for the full year, revenue increased 34%, And you can read the rest of the numbers here. I'm not going to go into them. We got to get into the DCF. So anyway, what's going on? What's going on here is this is the historical chart for Zscaler. You can see Zscaler is growing exponentially. They're slowing down a little bit, but they have grown exponentially. And you can see here the light blue bar is the revenues. The orange bar is the one you have to pay attention to. That is their net income. Their operating income is the orange bar. Keep in mind though, this chart is 1 month or 1 quarter out of date. So their last quarter is actually not represented in this chart, but their operating income was in the negative as we just discussed in the last quarter. Same thing with this chart, it's 1 quarter out of date, but this is the earnings per share, but you can see that the earnings per share is improving, and it's improving dramatically over the last few quarters, which is great. Cash flow is also improving dramatically. Look at this. This is a huge improvement in free cash flow over the quarters. I mean, it's getting massive now. Free cash flow is becoming a massive beast for Zscaler. They're printing money, and they're using this money for purchases and to expand their business. They are expanding, big league in acquiring new hardware infrastructure because they need firewalls and things like that to protect their networks, and just expanding so they can acquire new customers and more customers and get that 500 billion transactions higher. In terms of their balance sheet, you can see when they went public right there in Q2 of 2020, and their balances their balance sheet has just improved since then. You can see the stockholders' equities crossed $1 billion. So their difference between their assets and their liabilities is growing. So everything's fantastic there. For their outlook for fiscal 2025 is $604 million to $606 million. Non-GAAP income from operations, $114 to $116 million, and yada yada. Okay, so for the full year next year, they're expecting revenue of approximately $2.6 to $2.62 billion. Now, this is where analysts got a little freaked out. This is why the stock plummeted. It plummeted because this is a 20% increase over the prior quarters. And I'll go over that in a second. On the earnings call, they noted that a lot of the questions actually were about that 20% billings increase. And what they stated was that they're actually transitioning from a more even financial metrics from the 4 quarters to being second half weighted due to certain issues. But anyway, their revenues are in this fiscal 25 are going to be lighter in the first half, heavier in the second half. They're about, I think it's 7% growth they're expecting in the first half, 23% growth in the second half of fiscal 25. And they're probably expecting that going forward. They blamed an actually higher level of attrition in quarter 3, the previous quarter from the last one. So anyway, and they're saying that level of attrition affected their customer onboarding because it takes several quarters to onboard a customer, and then they get billed yearly. Some of them are on a 1-year billing cycle. Some customers are on a 3-year billing cycle. That's basically what's happening there. What's Wall Street think? Honestly, I don't care too much what Wall Street thinks, and neither should you. You should not care what Wall Street thinks. Don't even care what I think. The important thing is, what do you think Zscaler is worth? So anyway, Wall Street thinks Zscaler's price target is $214 per share for a 28% upside, with 20 strong buys, 8 buys, 14 holds, 0 sells, and 0 strong sells. Let's get into my DCF. This is what you're here for, right? It's foreplay is over. Let's get to the DCF. So what is DCF? DCF stands for discounted cash flow. What it basically means is that the value of your company is the sum of all of your future cash flows discounted to the current day's value, to current day monetary value, to present day value. That's basically what that means. And there's actually a issue here with DCFs in terms of Zscaler. The issue with Zscaler, and you can see how DCFs are used for all these purposes, but the issue with Zscaler is, look at the adjusted EBITDA after tax. Negative $98 million in 2020, negative $183 million in 2021, negative $300 million in 2022, negative $191 million in 2023, and negative $83 million in 2024. These are actual numbers. All these numbers are actual because fiscal 2024 is over for Zscaler. And you can see here the revenue growth is 56%, 62%, 48%, and 34%, declining to 20% in 2025. So that's a heavy decline. That's why the stock plummeted after the earnings report last week. Now, the reason why DCFs don't really work that well for companies like Zscaler is because Zscaler's not making a profit. Because, as I mentioned, my adjusted EBITDA, I subtract stock-based compensation. That's the main thing between my adjusted EBITDA and the company's reported adjusted EBITDA. Is I don't add back in stock-based compensation because it's a real expense. It's an expense for you. It's an expense for me. It's an expense for investors. It needs to be accounted for. And remember, that's 25% of revenues is stock-based compensation. So I account for that. And the reason why it harms DCFs is because the first several years, actually, are going to be negative cash flows. And that's what makes DCFs not applicable, not a good metric for Zscaler. That's why I have a couple of other metrics that I'll show you in 1 second. So you can see revenue growth. This expected for 2025 is 20%. I'm also expecting 20% in 2026, and then declining gradually to 10% in 2034. These are my future projections. This is where you can sort of differ your opinion from mine. If you have a different opinion on those, actually you can go to my Patreon, download my DCF on Zscaler. It's up on my Patreon. You can modify the numbers, and it will give you your intrinsic value for Zscaler. So yeah, and this is the numbers in graph form. So you can see they're going to grow to over $9 billion by 2034. My projections. The whack-a-mole chart, the famous whack-a-mole chart, 7.89%. This is the discount rates in the DCF. Now, this is the metric I was talking about earlier, is I'm expecting 2025 to have negative adjusted free cash flow unlevered of $188 million, negative $120 million in 26, negative $18 million in 2027, finally getting to profitability in 2028. And this is why DCFs traditionally aren't really good for this type of company. They're investing heavily in themselves and are currently not profitable on a net income basis, including stock-based compensation. So anyway, this gives you a bogus implied stock price, $156.87. However, I have two other valuation metrics. See, the thing is, when DCFs don't work, they need to go to multiple valuations. So I did an adjusted EBITDA multiple valuation on Zscaler. I'm assuming in a multiple of 20. Again, this is including stock-based compensation. This gives us an implied stock price of $183.53. Also, I did a price per sales multiple valuation. What I do is I did a value in 2034. The value in 2034 is going to be, I think, $100 billion at a multiple of 11 based off the numbers earlier, the revenue earlier. Now, that's 4 times today, 3.83 times today's valuation. So we discount that back. The discount factor is 1.96. That gives us a present value of $51 billion, diluted shares of 164 million, for an implied stock price of $311.87. You can see that that's actually quite a bit of difference between the adjusted EBITDA and the multiple valuation. So when it comes to the actual DCF, my what I think Zscaler is worth today, I just averaged those two, and I gave the perpetual valuation a weight of 0. So you can see the weighting here. The DCF perpetual, I said, you know what? This number is bogus. 0. I gave the EBITDA a 0.5 rating and the price per sales of 0.5 rating. That gives us an implied stock price of $247.70 for an upside of 44.22%. So yeah, head on over to my Patreon. You can download my DCF valuation on Zscaler, plug into your numbers, and it will automatically calculate your intrinsic value for the company. So do that, and then post the value that you get for Zscaler in the comments down below. you can get access on Patreon for as little as $5 per month. This is the best deal you'll ever find. I also cover companies like AMD, Tesla, Nvidia, Nike, Ulta, and I cover 15 different companies. And yeah, it's only $5. It's a can't miss value. It's the best deal you'll ever find. So yeah, don't forget to like and subscribe. Thank you for watching. Now I'll see you in the next one.